Have you ever wondered what private money lending is and how it works? Let's dive right into it. Private money lending is a financial strategy where individuals lend their personal money to borrowers for a return, typically in the form of interest. Unlike traditional banks or financial institutions, this strategy is more personal and often more flexible. Now, why is this a hot topic in the investment world? Well, it's simple. As an investor, you have the potential to earn significant returns on your investment. In addition, you have the power to negotiate terms that suit you, making it a flexible and potentially lucrative investment strategy. Think of it as a two-way street. It's a win for borrowers who may not qualify for traditional loans, and it's a win for investors seeking a high return on their investment. So, intrigued yet? Stay tuned to learn more about this intriguing investment strategy. Private money lending isn't a new concept. It has a rich history that dates back centuries. In fact, it's as old as civilization itself, tracing its roots back to ancient societies where the exchange of goods and services was backed by a promise of repayment. In the cradle of civilization, Mesopotamia, lending was a common practice. Merchants would lend grain to farmers in exchange for a promise of repayment after the harvest. These were the earliest forms of private money lending, with the grain acting as the loan and the future harvest as the interest. Fast forward to ancient Rome, and we see a more formalized system of lending. Wealthy individuals would lend money to the state in times of war, expecting to be repaid with interest once the conflict was over. This practice laid the foundation for modern-day private lending, where investors lend money in exchange for a return on their investment. The Middle Ages saw the emergence of the Bill of Exchange, an instrument that allowed merchants to lend money to each other across vast distances. This innovation sparked the growth of international trade, and is the precursor to modern banking and lending systems. In the centuries that followed, lending practices continued to evolve, shaped by economic, political, and social changes. The Industrial Revolution, for instance, brought about a surge in private lending, as entrepreneurs sought funding to fuel their innovative ventures. In the 20th century, private money lending became more structured and regulated, leading to the diverse investment landscape we see today. It's no longer just about lending grain or gold. Private money lending now encompasses everything from real estate and business loans to personal loans and peer-to-peer lending. The evolution of private money lending has been driven by the constant need for capital and the desire for a return on investment. Over the centuries, it has proven to be a resilient and adaptable form of investment, able to weather economic ups and downs and meet the ever-changing needs of borrowers and investors. This rich history has shaped private money lending into the investment powerhouse it is today. So, how exactly does private money lending work? Well, let's delve into the mechanics of it all. At its core, private money lending is a simple process. It involves an individual or a group of individuals providing a loan to a borrower. These lenders are not banks or traditional financial institutions. They are often business-minded individuals or companies looking for profitable investment opportunities. Now, let's break it down into three main components: the loan, the collateral, and the return on investment. First, the loan. This is the amount of money that the private lender provides to the borrower. The size of the loan can vary greatly, depending on the purpose of the loan and the borrower's needs. It could be anything from a few $1,000s to millions. Next, we have the collateral. This is a form of insurance for the lender. The borrower pledges an asset, often real estate or business equipment, to secure the loan. If the borrower fails to pay back the loan, the lender has the right to seize this asset and sell it to recover their funds. This is also why private money loans are sometimes referred to as hard money loans. The loan is backed by a hard asset. Finally, the return on investment. This is the profit that the lender makes from the loan. It usually comes in the form of interest payments from the borrower. The interest rate on a private money loan is typically higher than that of a traditional bank loan, often anywhere from 8 to 15%, depending on the risk associated with the loan. This higher interest rate is what makes private money lending an attractive investment opportunity for many lenders. It's important to note that while the mechanics of private money lending may seem straightforward, it requires a keen understanding of the financial market, the borrower's ability to repay the loan, and the value of the pledged collateral. Understanding these mechanics is crucial for anyone considering diving into private money lending. Like any investment strategy, private money lending has its pros and cons. Let's start with the benefits. First off, private money lending can offer higher returns compared to traditional investments. It's not unusual for private lenders to earn double-digit interest rates, a significant bump from the single-digit rates typical of bank investments. Second, private money lending allows for greater control over your investment. As the lender, you choose who to lend to, how much to lend, and at what terms. You can therefore tailor your investment to suit your risk tolerance and financial goals. Third, this type of lending can offer a steady stream of income. Unlike stocks or bonds, which can fluctuate wildly, private money loans provide a consistent return over the loan period, which can be a boon for those seeking stability in their investment portfolio. But, just like a coin has two sides, private money lending is not without its pitfalls. The biggest risk is default. If a borrower fails to repay the loan, you could lose your investment. And while high interest rates can translate to lucrative returns, they also reflect the high-risk nature of these loans. High rates are charged because these loans are often given to borrowers who might not qualify for traditional bank loans, indicating they may be a higher risk. Moreover, private money lending can be a labor-intensive investment strategy. Unlike investing in a mutual fund where a professional manager does the heavy lifting, private lenders must vet borrowers, negotiate terms, manage the loan, and deal with any issues that arise. Furthermore, there's the risk of legal complications. Private money lending is heavily regulated, and failing to adhere to these regulations can lead to legal trouble. Finally, private money lending lacks the liquidity of other investments. You can't quickly convert your loan into cash without potentially suffering a loss. Weighing these pros and cons can help you make an informed decision about whether private money lending is right for you. Let's consider some real-world examples to better understand private money lending. Imagine a small business owner, let's call her Sarah, who needed funds to expand her bakery. Traditional lenders turned her down due to her limited credit history. A private lender, however, saw the potential in Sarah's business and agreed to lend her the funds at a higher interest rate. Sarah was able to get the money she needed to buy new equipment, hire more staff, and grow her business. Today, Sarah's bakery has tripled its revenue and she was able to pay back the loan in full, plus interest. This is a prime example of a successful private money lending transaction. Now let's look at a less successful example. Jake, a real estate developer, approached a private lender for a loan to finance a new residential project. The lender, attracted by the high interest rate, agreed. However, Jake underestimated the costs and time needed to complete the project. He defaulted on the loan, the project was abandoned, and the lender lost a significant amount of money. This example illustrates the risk associated with private money lending. Lastly, consider the case of a startup tech company. The founders approached a private lender for a loan to launch their innovative product. The lender, impressed by the founders' passion and the product's potential, agreed to the loan. The startup used the funds to develop and market its product, which turned out to be a huge success. The company was able to repay the loan, and the lender made a substantial return on the investment. However, it's important to remember that not all startups are successful. For every success story, there are countless others that fail, leaving the lender with a loss. This is why private money lending requires a careful evaluation of the borrower's ability to repay the loan and an understanding of the inherent risks involved. These examples illustrate the potential rewards and risks of private money lending. Now let's summarize what we've learned about private money lending. Starting with its origins, private money lending has been around for centuries, providing an alternative to traditional financial institutions. The mechanics of private money lending involve a private individual or company lending money to others in exchange for a return on investment, often in the form of interest or an equity stake in a project. We also explored the pros and cons of private money lending. On the upside, it can offer higher returns and more flexibility than traditional lending. On the downside, it comes with a higher risk due to the lack of regulatory protection. We've also seen real-world examples of private money lending in action, demonstrating its potential in various investment strategies. With this knowledge, you're now in a better position to decide if private money lending is the right investment strategy for you.